You know, in this game of speculation, the real money isn't made by catching every little wave. It's made by getting aboard the right tide before it rises. That's what separates the amateurs from the professionals. Today we're going to talk about something that every trader dreams of, but few truly understand. How to find big moves first. And if you remember the previous video on how to boost your trading win rate fast, you'll notice this ties directly into the same foundation. Patience, precision, and preparation before you ever click that buy or sell button. Now, let me tell you something from experience. Big moves don't just appear out of nowhere. They're born in silence. They start when the crowd is bored, when the tape is quiet, when most traders are busy looking the other way. That's when the groundwork is being laid. You see, the market has a habit of whispering before it shouts. Do you ever catch yourself looking for excitement instead of opportunity? That's where most traders go wrong. The big moves start where there's the least noise, not the most. When I was younger in the bucket shops, I used to chase every flinch on the ticker. A little move up, and I'd jump in. A quick dip, and I'd jump out. I thought that was trading. But the truth hit me hard and fast. The real money came not from trading often, but from waiting for the right setup, the right signal that hinted a real move was about to unfold. And that, my friend, is where you have to train your eyes and your mind to see what the public can't. A market doesn't turn because of magic. It turns because the balance of power shifts. You can see it in the price action if you're patient enough. The best traders don't predict. They recognize. They recognize when the tape is acting different. Maybe the stock stops dropping on bad news. Maybe volume dries up on sell-offs but swells on rallies. Those are not accidents. Those are footprints of the big operators moving in quietly before the storm. Ask yourself, are you watching the story or are you reading the tape? Most traders try to buy after a move has already started, when the papers are printing headlines and the crowd's excited. But by then, it's too late. The smart money has already positioned itself. You can't find big moves by following the crowd. You find them by noticing when the market stops, following its usual rhythm. That's why I always say, don't watch prices just to know what they are. Watch how they behave. It's the behavior that gives you the hint. And remember, price patterns don't make the move. The forces behind them do. You've got to learn to sense accumulation and distribution. In accumulation, the stock moves sideways, maybe even a little dull. But if you look closely, the dips are shallower, the rally's a bit stronger, and volume comes in quietly. It's like watching a cat crouch before it leaps. Most people see nothing. The trader sees potential energy. Tell me, how many times have you ignored a quiet chart only to see it explode later? Now, if you recall from that last video on how to boost your trading win rate fast, we talked about focusing on high, quality trades instead of frequent ones. Well, that principle applies double here. To catch big moves first, you've got to narrow your attention to setups that truly deserve it. The fewer decisions you make, the sharper your instincts become. You can't chase noise and expect to recognize music. The market rewards discipline, not excitement. The amateurs trade for action, the professionals trade for results. When I study a stock, I look for the signs of quiet strength. Maybe it refuses to fall when the general market dips. Maybe it keeps bumping against resistance with a little more force each time. Those are signs that something is cooking beneath the surface. I don't rush. I let the stock prove itself. And once I'm in, I let it work. Big moves take time to develop, and they demand the patience to sit tight once you've got the position right. Now, here's a truth that many can't stomach. Most people miss big moves, not because they can't find them, but because they can't wait for them. They want the thrill of being right every day. But in trading, it's not about being right. It's about being ready. The readiness comes from study, observation, and a calm mind that can sit through boredom without forcing trades. Can you wait without growing restless? That's the real test. You see, money in the market flows from the impatient to the patient. Always has, always will. When you learn to detect accumulation, when you sense that quiet tension before the spring, you're already ahead of most traders. And once you've trained yourself to recognize those conditions. You'll start to notice how often the market repeats its old tricks. The faces change, the tickers change, but the behavior doesn't. That's the beauty of speculation. Human nature never leaves the tape. Let me tell you another thing. Big moves don't just reward knowledge. They reward conviction. You can have the right read and still miss out because you lack the nerve to hold. The market tests you, shakes you, tries to make you doubt your own judgment. That's why mindset is half the battle. A trader with courage and patience will make more than a clever man who's easily rattled. So when you find that trade that fits all the signs, don't be afraid to commit, but also don't kid yourself. Conviction without preparation is just stubbornness. Now, a lot of traders ask me, Jesse, how do you know when to pull the trigger? Well, the truth is, you never know. You learn to recognize the odds lining up in your favor. When price, volume, and behavior all sing the same tune, that's your cue. The secret is not in predicting, but in waiting for confirmation. You don't jump at every tick. You strike when the odds are clear. That's how you get in early, before the crowd wakes up. And here's something worth remembering. The market always gives a clue, but it whispers it first. It tests the observant, not the loud. If you can train yourself to spot those whispers, the tightening ranges, the shrinking volatility before a break, the subtle shift in volume, you'll begin to see the same thing I saw years ago. The move starts before it's visible. The tape tells the story, if you know how to listen. So ask yourself right now, are you studying charts just to find trades, or are you studying them to understand the story behind the moves? Because if you learn to read the story, you'll start finding those big moves before they happen, when they're still cheap, still hidden, still waiting for the world to notice. The market whispers before it shouts. Watch for subtle clues. That's a lesson every serious trader must carve into their mind. The tape never lies, but it rarely tells its truth loudly. If you're waiting for the newspapers to announce a new bull market or for the commentators to confirm a trend, you're already too late. The market always speaks in hints before it makes its move, and those hints come in the form of price behavior, volume changes, and the quiet way a stock refuses to act. Normal. Most traders miss these signals because they're too busy looking for something dramatic. They want thunder before they see the clouds. But in this business, you must learn to hear the rustle before the storm. When I say the market whispers, I mean it shows its intentions subtly, almost shyly. Think of a stock that has been declining for months. The news is bad, the sentiment is gloomy, and everyone's convinced it's finished. Then one day it stops dropping on bad news. A week later, it starts rising on light volume. The public ignores it because it doesn't look exciting yet. But a trained eye sees something unusual. The selling pressure is easing, and the stock is acting stronger than it should. That's a whisper. That's how the big moves start. Have you ever noticed a stock holding firm when everything else is falling? That's not coincidence. That's someone quietly accumulating while the rest of the market sleeps. Big operators, those who move real money, never announce their plans. They accumulate silently, in small bites, because they don't want to draw attention. And the tape reflects that in small, almost invisible changes. Volume spikes slightly on up days, contracts on down days. The range tightens. The stock refuses to make new lows. These are subtle, but they're the market's way of whispering. Something is changing. The amateur ignores it. The professional prepares. The amateur wants confirmation. The professional listens for the undertone. Which one are you? To catch the whispers, you must slow down your own mind. Most traders watch the market with anxiety, eager to act, eager to prove themselves right. But the market rewards patience, not speed. The best trades I ever made came after long periods of quiet observation. I'd watch a stock for weeks, sometimes months, waiting for its character to shift. One day, it would move in a way that didn't fit the pattern. A strong close when it should have been weak, or a refusal to drop when the market was sliding. That's all it took. The whisper had spoken. This is why chart reading isn't about memorizing patterns. It's about developing intuition through observation. You learn what normal behavior looks like, so you can spot when it turns abnormal. That's how you detect accumulation before the breakout or distribution before the breakdown. If you wait for the obvious, you'll be trading behind the crowd. The trick is to recognize the early signs when the market is still trying to hide its hand. The whispers show up in the small details: tightening price ranges, reduced volatility, volume drying up near the lows. They seem unimportant, but they're the quiet signals that precede the move everyone will later call obvious. Now, let's tie this back to the principle from that earlier talk on how to boost your trading win rate fest. Remember how we discussed that a trader's edge comes from preparation, not reaction. Listening to the market's whispers is the same idea. You don't wait for confirmation from the crowd. You prepare before the crowd even notices. You refine your watch list, analyze your charts, and wait for that shift in tone. When the whisper becomes a murmur, you're ready. Most traders are chasing what's already happened. You want to position yourself for what's about to happen. That's how you find big moves first. A whisper could be a change in correlation too. Maybe the stock stops moving with the market. While the index dips, it holds flat, or better yet, rises slightly. That tells you someone's buying with conviction. Volume is the heartbeat of the market, and if you learn to listen to it, you'll hear the rhythm change before the song does. I've seen it time and again. A dull market suddenly springs to life because a few people noticed the subtle shift early. They didn't guess, they observed. Observation, not prediction, is the trader's real tool. The hardest part is trusting those whispers without jumping too early. Many traders catch a small clue and rush in, afraid to miss out. But a whisper isn't a command. It's an invitation to watch closer. The goal is not to react instantly, but to recognize that the character of the market is beginning to change. When the behavior aligns across price, volume, and time, that's when the whisper becomes a signal. If you enter too early, you'll be shaken out before the move starts. The discipline is to listen patiently until the pattern completes itself. And remember, whispers fade if they're ignored. The market tests your ability to stay observant through monotony. Most traders can handle volatility but not boredom. They want movement every day, but the big opportunities grow in the quiet stretches when nothing seems to happen. That's when professionals are studying, building conviction, and getting ready. The whisper phase is the incubation period of every great trend. Sometimes, the whisper takes the form of failure, a stock that breaks down but can't follow through. That's also information. The market is saying, there's no more supply down here. That's how bottoms are born. It's not always about strength. Sometimes the absence of weakness tells you the story. You must be sensitive enough to notice when the market stops doing what it's supposed to do. So, when you look at your charts tonight, don't just ask what the price is doing. Ask what it's trying to do and failing at. That's where the whispers hide. Train your eyes to spot that quiet divergence, the hesitation before the change. Because by the time the shouting starts, by the time the crowd notices the breakout, the easy part of the move will already be gone. Big profits come to those who wait for confirmation before acting. That's one of those truths that every trader learns eventually, sometimes the hard way. The market is full of noise, of sudden flares and false starts that tempt you to jump too soon. You see a quick move and think, this is it. But more often than not, those early moves fade as fast as they appeared. The difference between a gambler and a trader is simple. The trader waits for confirmation. The gambler jumps on impulse. In this business, confirmation is your insurance policy. It won't guarantee you profits, but it will protect you from unnecessary losses. When I talk about confirmation, I don't mean perfection. You'll never have all the answers. What I mean is waiting for the market itself to prove your idea right before you commit your capital. The tape tells you when it's time. It's the moment when the story aligns. The price, the volume, the behavior. A stock that's been struggling finally breaks through resistance and holds. Volume expands, but the price doesn't retreat. That's not luck, that's confirmation. But tell me honestly, how many times have you jumped in before that moment, only to watch the move collapse under its own weight? The urge to anticipate the market is powerful. Every trader feels it. You see a setup forming, and your mind whispers, "If I wait too long, I'll miss it." But missing one trade is nothing compared to losing money on a false start. The professionals know this. They'd rather be late and right than early and wrong. You see, big profits aren't made by guessing. They're made by aligning with the market once it's ready to move. The amateurs try to predict, the pros wait for proof. That patience is what separates winning trades from wasted effort. Waiting for confirmation is not about hesitation. It's about discipline. It means you have a plan and the control to follow it. The best traders don't chase every breakout. They watch how the breakout behaves. A real move holds its gains, consolidates, and builds strength. A false one fizzles quickly. The difference lies in the behavior after the initial push. That's why I always say, don't just trade the breakout, trade the follow-through. A move that can sustain itself is worth your money. Everything else is just bait for the impatient. You can apply this thinking to any market. Stocks, commodities, currencies. It's all the same game because it's all driven by human nature. People get excited early, they jump in too soon, and they end up feeding the professionals who wait just a little longer. The pros let the amateurs test the waters first. When the noise settles and the move holds firm, then they act. That's the rhythm of trading. Can you hold yourself back long enough to let the market prove itself? That's the real question. There's a certain power in waiting. You're not reacting, you're observing. You're letting others show their hands before revealing yours. The market's first move is often a test. It shakes out the weak hands, triggers stop losses, and confuses the unprepared. But when the dust clears, when the price stabilizes and volume supports it, that's when the real move begins. The tape confirms what the setup promised. And that's when a trader with patience steps in and rides the wave while others are still wondering what happened. If you remember the principle from the earlier video on how to boost your trading win rate fast, you'll see the connection here. We talked about improving your odds by waiting for higher quality setups. Well, confirmation is what turns a setup into a signal. It's the bridge between an idea and an opportunity. You might have the right direction, but without confirmation, you're trading on hope. With confirmation, you're trading on evidence. That shift, from guessing to validating, is what improves your win rate and builds long-term consistency. Let's say you're watching a stock approaching a key level. You see the potential. Maybe it's forming a base after a long decline. The setup looks good, but you don't pull the trigger yet. You wait. The next day, it tries to break out. Volume picks up, but then it fades back into the range. No confirmation. You keep waiting. A week later, it breaks out again. But this time, it holds above resistance, and the volume stays heavy. That's confirmation. The market is now saying, yes, I agree. When you enter there, you're trading with the trend, not against it. It's no longer your opinion. It's the market's validation. The great traders always wait for the market to show its hand. Livermore himself used to say that a man must never argue with the tape. The tape is never wrong, but it often takes time to make its message clear. That's why jumping ahead of confirmation is so dangerous. You're trying to speak before the market has finished its sentence. You have to let it complete the thought. The first break may be a tease, the second may be a trap. Only when the price acts right and volume supports it can you trust the move. The psychology behind this is what makes trading so difficult. People don't like to wait because waiting feels like missing out. They crave action. But the truth is, most of trading is waiting. Waiting for setups, waiting for signals, waiting for the right moment. The money is made not by doing more, but by doing less with greater precision. Every false start you avoid by waiting for confirmation saves you not just money, but emotional capital. And emotional capital is as precious as cash in this business. Think of confirmation as your compass. It tells you that the market agrees with your analysis. Without it, you're wandering in the dark. When you have it, you move with the current instead of against it. And when you learn to trust that process, you stop chasing and start executing with confidence. That's when your trading becomes calmer, sharper, and more profitable. Because once you've learned to wait for confirmation, you've learned one of the hardest and most valuable lessons in speculation. Big moves begin in quiet markets, not noisy ones. That's the paradox of speculation. Most traders look for action, for excitement, for movement they can feel in their bones. But the market doesn't reward excitement. It rewards observation. The biggest, most powerful trends always start when nobody's paying attention. When the tape is dull, when the headlines are quiet, when volume dries up and the public has lost interest. That's when the groundwork for something big is being laid. You see, the market doesn't announce its intentions. It hides them in the silence. I've seen it happen time and time again. After a long decline, when everyone has given up, prices stop falling. There's no rush, no drama, just stillness. People call it a dead market, but that quiet is a signal if you know how to read it. The professionals begin to move quietly during these times. They're not chasing, they're accumulating. Slowly, methodically, almost invisibly. By the time the crowd wakes up, the position has already been built. Tell me, how often have you seen a stock that looked lifeless for months suddenly burst into life? That's not coincidence. That's preparation finally revealing itself. Noise attracts the inexperienced. They want to be where the action is, where the candles are tall and the moves look exciting. But by the time a market gets noisy, the smart money is already positioned. They're selling into that excitement, unloading to the crowd that's just arrived late to the party. It's human nature. People want to feel part of something moving. Yet the real profits are made before the movement starts. The quiet markets are where the professionals work. The noisy ones are where the amateurs play. You can think of it like planting a seed. The growth doesn't happen when the farmer is shouting about it. It happens underground, unseen, in stillness. Then one day it breaks through the surface and everyone says, "Where did that come from?" But the truth is, the work was happening long before. The same is true in trading. A big move always has a foundation, accumulation, compression, a drying up of supply. You have to learn to recognize those conditions when the market looks least interesting. That's when opportunity is at its highest. Quiet markets also test your discipline. It's easy to trade when everything is moving fast. You feel alive, you feel engaged. But can you stay patient when nothing is happening? Can you keep studying, keep watching, when there's no excitement to feed you? That's the real test of a trader's maturity. The professionals understand that waiting is part of the job. They know that dull periods are when preparation pays off. Because the next big move is being shaped in that stillness, and only those who endure it will be ready to act when the time comes. If you remember the principle from our previous video on how to boost your trading win rate fast, you'll recall how I talked about focusing on quality over frequency. That lesson applies perfectly here. Quiet markets produce the setups worth waiting for. You don't need to trade every day. You need to trade when the odds are aligned. By stepping back and studying those silent periods, you can spot the turning points before they're obvious to the crowd. You boost your win rate not by trading more, but by being more selective, and that means learning to love the quiet. Look closely at any great bull market, and you'll find the same story. It starts in boredom and ends in frenzy. The early stages are slow, uneventful, and full of doubt. People say, "Nothing's happening, it's going nowhere." But beneath that surface, supply is being absorbed. The stock stops making new lows. Volume dries up as sellers disappear. Then, gradually, you see strength creep in. A higher low here, a small breakout there. That's the whisper before the shout. When it finally explodes, the public thinks it came out of nowhere. But the professionals saw it coming months in advance, during those quiet days when no one else cared. You have to train yourself to see quiet as opportunity, not as emptiness. The crowd sees a lack of movement and thinks there's nothing to do. The professional sees the same chart and thinks, something's building here. That shift in perspective is what separates winners from losers in this game. When markets go silent, most people switch off. But the trader who stays alert, who keeps reading the tape, will notice the subtle signs. The tightening of ranges, the shrinking of volatility, the resilience against selling pressure. Those are the footprints of the next big move forming. It's also important to understand that quiet doesn't mean inactive. It means balanced. Buyers and sellers are fighting evenly, neither side dominating. That balance can't last forever. Eventually, one side gives up and the balance breaks. That's when the move begins. Your job is to be there when that break happens, already aware of the tension building beneath the surface. By the time the market grows noisy, you're already in position, watching your idea unfold while others are just discovering it. Many traders waste their best energy chasing volatility instead of studying stillness. But volatility is a symptom, not a cause. It's the result of imbalance, of something that started quietly and matured into motion. The professional trader wants to be there before the imbalance breaks. That's where the real money is made. It's not in the fast move itself, but in the recognition of its potential before anyone else sees it. So when the market seems dull, when everyone's complaining there's nothing to trade, that's when you should be paying the most attention. The silence is not emptiness. It's information. It's the market catching its breath, the players shifting their positions, the forces gathering strength. If you can sit through that and keep your mind clear, you'll begin to notice things others overlook. Price behavior matters more than price levels. That's a truth that every great trader eventually comes to understand. Most people in the market obsess over numbers, where the price is, how high it's gone, or how low it's fallen. They anchor themselves to round figures and psychological levels, thinking that price itself tells the story. But it doesn't. The story lies in how the price moves, not where it stands. You could have two stocks both trading at $50, and yet one is ready to explode higher while the other is preparing to collapse. The number doesn't tell you that. The behavior does. When I talk about price behavior, I mean the character of the movement, the way the market reacts to pressure, to news, to buying and selling. It's the rhythm of the tape, the tone behind the figures. Does a stock rise easily, or does it struggle to gain a few points? Does it fall sharply on small volume, or does it hold firm under heavy selling? These clues tell you what's happening beneath the surface. A trader who only sees price levels is like a man who reads the words but misses the meaning. The tape always speaks in behavior, not in numbers. I remember when I was first trading in the bucket shops. I used to think that hitting new highs meant strength and new lows meant weakness. That's what the books said, and it made sense to a beginner. But over time, I saw that the truth was more subtle. Sometimes a stock would make a new high, but immediately reverse. It couldn't hold its gains. That wasn't strength at all, it was exhaustion. Other times, a stock would make a new low, then rebound sharply and refuse to drop again. That wasn't weakness, it was strength disguised as failure. The behavior told the truth, while the level missiled everyone watching. This is why I always say watch how the price acts around key points, not just the points themselves. A resistance level is meaningless if the market breaks through it with conviction. A support level is worthless if the price slides below it easily. It's the way the market behaves when it tests those levels that gives you the real insight. Do you see quick rejection or slow grinding acceptance? Is volume confirming the move or contradicting it? That's the trader's edge, reading behavior, not reacting to numbers. A trader's greatest tool is observation. You don't have to predict, you just have to recognize when something is acting right or wrong. A stock in an uptrend that refuses to drop even on bad news is showing strong behavior. A stock in a downtrend that rallies on light volume but collapses quickly on selling pressure is showing weak behavior. You can't measure that with price levels. It comes from watching, feeling, understanding the flow. And the more you study that behavior, the more you'll see that numbers are only the surface of the story. Most traders lose money because they treat price as a destination instead of a living process. They say, if it hits this level, I'll buy, or if it drops there, I'll sell. But the market doesn't care about your levels. It cares about energy and momentum, about supply and demand in motion. That's why you'll often see false breakouts and fake breakdowns. The crowd acts on the level, the professionals act on the behavior around it. Tell me, how many times have you seen a perfect breakout that failed the very next day? That's what happens when you trade levels without reading behavior. Price behavior also reveals the psychology of the participants. When a market hesitates near a level, it means traders are uncertain. When it surges and holds, it means conviction. When it spikes and fades, it means emotion without foundation. Every tick on the tape is a reflection of human behavior: fear, greed, hesitation, confidence. If you can learn to read those emotions in the movement of price, you'll always be one step ahead of the crowd that's still waiting for a signal from some arbitrary level. This ties directly back to what we talked about in the earlier video on how to boost your trading win rate, fast. Remember how we discussed focusing on setups that show strength, not just structure. Price behavior is the clearest expression of that principle. The market can draw a perfect chart pattern, but if the behavior inside that pattern is weak, hesitant, choppy, inconsistent, the setup isn't real.